We're at Gold Stock Analyst Day, and joining me now is someone who works very closely with John Doody. He's the associate editor of Gold Stock Analyst, Garrett Goggin. Garrett, good to see you again.
Nice to see you, Daniela. Thank you very much for joining us. We're really happy you're here again.
Well, thanks for having us. And Garrett, last year you spoke with us. You had some interesting comments. You were comparing gold's correction to what had happened in 1975, and you said the lesson to be learned is that, well, gold is a volatile market. So how do you expect the volatility to play out this year? How do you see things set up for gold?
We see the volatility continuing. We see 2015 being an extremely volatile year. Back in the 70s is the comparison that we take a look at often, and in the 70s gold declined over a period that we're basically close to matching right here in 2015. But I follow a lot of technical indicators as well regarding the gold price, including the commitment of traders, the CFTC, which releases the speculative positions, and it releases commercial positions. And the commercials are 40% net short right here. And the last times they've been 40% net short since 2010, we've had a gold price decline. And from peak to trough, the gold price decline has lasted 3 months.
Okay.
So they basically have been net short 40% since the end late February. So we potentially could get a gold washout through spring, April, May time, which could be an amazing buying opportunity.
Okay, so you could see May, good time to possibly buy gold.
Yes.
Okay, do you see things picking up later in the year?
Oh yeah, absolutely. With all the economic stimulus that's being poured in. I'm a CFA, a chartered financial analyst, and it's always interesting talking to the CFA community about gold because it doesn't have a cash flow, it doesn't have a yield. You're not sure how to value it,
right.
But you know what? There's negative yields all around the world. So well, at least gold doesn't have a negative yield.
Right.
It does better than bank account in Switzerland.
And I know we're going to have Jim Grant on later in the afternoon. He's your keynote speaker here today. I'm going to ask him about interest rates, but do you think that the Fed will hike rates this year?
We follow a lot of economic indicators, and there's a couple people out there that seem to have been consistently right over time, including Jim Rickards. And Jim Rickards, doesn't see a rate hike until 2016.
Right.
And if we do see a rate hike, it's going to be a big mistake by the Fed this year. So we'll see how that.
Why do you say that?
Because we don't believe that the economy is as strong as the economic indicators, as what the economic press would like to lead you to believe. The participation rate is extremely low. The unemployment rate has gone down, but the majority of that is due to people leaving the workforce. So we don't think the economy is as strong as it is. For the top 1%, yeah, they're doing very well, but for the rest of the 99% of the country, everyone's struggling through.
Garrett, let's get back to the mining companies here. You have their top 10 presenting here. Now, cost cutting was a miner's focus primarily this year. How do you see things set up for the miners as we've started Q2 and in Q3?
Right. Well, in 2015, there were two positive things that happened that really helped out cash costs for gold miners. That was the decline of oil prices, because fuel is a major expense, and the lower fuel price helped lower miners' cash costs. And then secondly, the rise in the U.S. dollar over the past few quarters means that the other relative currencies, say Canadian dollars or Argentinian pesos, depreciated. So these miners' cash costs depreciated against the U.S. dollar, so the miners' cash costs came in, very low. They were surprisingly, positive over the past quarter, and we look for that trend, to continue through 2000.
So what advice would you be giving the miners? What should be their focus? Is it exploration? Is it more cost cutting?
Yeah. A lot of the miners, they've cut back tremendously on sustaining capex, and sustaining capex, impacts free cash flow. And as far as an investor goes, that's what you look at, bottom line free cash flow. The mining is an extremely capital intensive business. So the miners that have been cutting back in their capex, they've been sinking those savings right to the bottom line. Spoke to a couple miners that spent a lot on capex. They're looking at cutting back. One miner that we like is in our top 10 that's entering production this year. They're only spending enough money to prove up reserves that they're going to mine over this next 6 months. They're not spending any money on exploration, and we see that as wise, because those are savings that are going to benefit you.
And which company is that, Garrett?
Golden Queen Mining in California.
Well, Garrett, thanks so much for speaking with us today, and have a great conference.
Thank you. We appreciate you being here.
And thanks for watching our coverage here from Gold Stock Analyst. They will have more for you throughout the day, so be sure to stay tuned to Kitco.com. Thanks for watching.